Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update with our friend and colleague, Justin Huhn. Justin is the founder and publisher of the Uranium Insider, and we will put a link to that down below in the show notes so you can follow along with Justin's team's analysis on not just the uranium sector, but the nuclear fuel cycle and all the different elements that drive the different macro trends and micro trends within the sector. And so, Justin, it's always great to have you on the show to dig into the nitty gritty. Now, this is coming on the back of you having attended a large conference over in London, England, focused on the nuclear sector. And so, from a big picture standpoint, I'm curious, I'm sure people listening will be curious, what was the sentiment like at the show regarding the nuclear fuel cycle, everything from enriched uranium fuel and UF6 all the way down to U308, but also are the utilities back in the mood to buy? Are they doing contracts? What kind of boots on the ground information can you share with us from the conference you attended in London?
Sure, Shad, and thanks again for having me on. It's always fun to chat with you. The conference had just a very good vibe throughout the entire experience. I would say that there was an elevated mood, and this conference is not a fuel cycle specific conference, right? It's the World Nuclear Symposium. So you have representatives from utilities, representatives from fuel buyers for utilities. You have the actual nuclear builders. You have the investing side. Like everybody is there, mining representatives, et cetera. So they're all there, they're all connecting, they're all communicating and meeting. And it just to me felt like the mood was elevated for absolutely everyone. This is a enormous growth sector for anybody involved in the nuclear side of things. And then of course the investing sentiment was quite bullish. And the element of that bullishness that I liked or appreciated, at least at this juncture, is that it didn't feel to me like it was a bullishness based on the fact that the sector has moved very nicely from the lows of April until now. And actually, as we speak, we're having an absolute blowout day. We got stocks up, 10+% across the board, which is incredible, including the ETFs. Phenomenal move today on some news that the US is planning to build a uranium strategic stockpile. But the mood was based on the fact that we have this underpinned growth for the sector, and the uranium price has not moved yet. So while we've seen the stocks get smashed in Q1 into the early part of Q2, recover back to those levels and then some, with many of them moving up substantially greater than they were prior to that crash, let's say how the year ended, the uranium price has yet to really move. And that's what has the investing side so bulled up here. So it was a really good conference. There was a lot of general themes that were repeated throughout that conference, but your question about when are the utilities going to buy? Well, the utilities have been buying, they just haven't been buying in the long-term contracting market or in very large volumes. So what they've been doing is flexing up on old contracts. They've been buying some EUP, they've been buying conversion. And the really one of the feelings that I came away from this conference with as well, Shad, was that it feels like now it's time for uranium. So going to the conference last year, going to multiple fuel conferences over the last, 2+ years, is that especially with the invasion in Ukraine and the disruption or theoretical disruption to Russian material, there was so much more of a focus by Western utilities on both conversion and enrichment. And that's really been the thematic over the past 2.5 to 3 years. And we've seen that in the response and the prices in those markets. The focus, in our opinion, is about to be very strongly on uranium, and we have not even seen the price start to move. The spot market is moving up a little bit today. Happy to see that. But as far as big moves in the long-term price and breaching back above the highs we saw in the spot market last year of $106, that's what we have ahead of us. So that has us very excited.
Well, let's maybe dig in there just for one more question here on the fuel cycle itself, because a lot of people that are investors in other sectors, especially when they're in the resource space and they come into this, it's a little unclear the difference between the spot and the term market. And the spot's really for short term, I guess, under a year transactions that aren't really the same kind of effect on the long term cycle as the term market, which is really based on the contracts that utilities sign with the uranium companies because of how jammed up the fuel cycle is on the enrichment side and on sourcing, the enriched uranium fuel, the HALEU, and then also the UF6, it eventually trickles down into a need to buy uranium. And then that eventually leads to this long-term contracting cycle where the utility companies team up with the miners. So maybe speak on where you think we're at in that part of it and just how that affects the investments people have in uranium stocks.
Yeah, I mean, you're exactly right, Shad. The procurement of the services of conversion and enrichment require uranium feed. I mean, conversion specifically, but unless you can go out in the market and buy UF6 to feed into those enrichment contracts, you have to buy uranium and have it converted. And the UF6 market is even thinner than the uranium market. So, all of the focus that's been on those two markets over the past 2 years, it's not a theoretical exercise to say, well, eventually we could see. No, it's actual real demand in the uranium market to feed into those contracts that have been the focus of the Western utilities for the past 3 years. So that's exactly right. Now, expansion of enrichment is necessary. Expansion of conversion is necessary. We're hearing some moving and shaking on both of those fronts, especially on the enrichment front. And while a vastly expanded enrichment capacity globally would theoretically allow for centrifuges to run and operate at lower tails assays, therefore requiring, with all other things being equal, less uranium per kGU of EUP, the expansion of enrichment is essentially in line with the expansion of global nuclear capacity as far as what we can tell right now in our models. And of course, even operating at lower tails assays, you still need the feedstock. So it's not like more conversion and more enrichment replaces the need for uranium. It doesn't. All of those things are needed right now, even for us to remotely approach the type of quote unquote nuclear renaissance that's being proffered.
Well, and as we talk about the nuclear renaissance, it's kind of a redux of the previous nuclear renaissance, which happened in the prior cycle, and it was interrupted by Fukushima. Now, as we go about 15 years later, we're seeing all kinds of what we call right tail risks. Everything from these executive orders from the Trump administration on the nuclear fuel cycle, what we see at the COP29 conference, which you and I discussed in our last conversation about tripling their nuclear power by 2050. But even today, the news coming out about the U.S. doing a uranium strategic stockpile, maybe dig into some of these right tail risks and how they're just continuing to feed the long-term bull case.
Sure. This is one of those things that I like most about this investment is because for any commodity investment, you basically have to have some essential understanding of the supply and the demand outlook going out into the future, right? You have to know that it's cyclical, that high price will see supply response and on what kind of time frame. You have to understand what the demand picture is, at least for the near and the midterm. And once you have that, you can make some kind of predictions on what sort of commodity buying patterns that the industry is going to have to undergo in the coming years. And that's the core of the investing thesis, or should be, for this investment and really any sort of commodities investment. What makes this sector unique in many ways, and I discussed this in a long thread post on X last weekend a little bit more, is that you have the needs of the industry as a baseline, but then you have all of these other, what I called right tail risks to this investment that are potential. And if any of these manifest, what you end up seeing in a tight market is a significant disruption. So today, this disruption is hitting the screen right now. It's hitting the tape. Bloomberg is reporting that Christopher Wright, the Secretary of Energy in the United States, is saying that the U.S. is looking at reestablishing a strategic uranium reserve where the U.S. government will actually be buying uranium from U.S. miners. And it's setting the whole sector alight. And the article did not even announce numbers, like how much they're going to be spending, how soon, anything like that. It's just the way that the market reacts to these sorts of headlines. But strategic sovereign stockpiles is one of many potential right tail risks. Significant inventory building by any nuclear utilities, you have the potential for the tech companies to actually get directly involved in the nuclear fuel cycle, which, by the way, it sounds like they are, and they're definitely paying much, much more attention to the goings on in the fuel cycle. You have financial buying, and this is a big one that's just hanging over the sector all the time now. We all know that Yellowcake has a deal with Kazatomprom to buy $100 million worth of uranium every year. Of course, they have to trade basically close to or ideally at a premium to NAV in order to do that raise, which they haven't been able to do in a couple of years. But they have that mechanism. You have hedge funds that often will buy uranium, and they've been doing a bit of that this year as well, buy and sell. But this year they've been buying. They were selling, I would say, the early part of Q1, but they've been buying again in the most recent months. And then, of course, you have Sprott. And Sprott, the Sprott Physical Uranium Trust, can raise cash via an ATM when the vehicle is trading at NAV. or at a premium to NAV, ever so slight premium to NAV, they'll issue units in the open market, raise cash. But of course, earlier this year, and I know we discussed this in a previous conversation, but worth repeating, they did an initial $24 million raise off the market, private placement at like a 3 or 4% discount to where Sprott was trading in the open market. That kept the lights on. It kept them from having to sell some uranium into the market to keep the lights on. So that was very positive. And then about a month later, we saw them raise 200 million in another off-market raise, private placement. So that set a precedent. And the ability for, let's say, big money to come in and quote unquote corner this market and do another raise or multiple raises of a spot off the market, it's absolutely there. When it will happen again is harder to say. The last one that was done, it was very secretive. So it didn't really leak out at all before it happened, the big raise anyways. So that's probably going to be the case again, but this is hanging over the market right now, Shad. And at any moment, we could see the financialization again of this sector come in a big way. So all of these things are lining up, and these potential right tail risks are absolutely there. They're hanging over a thin market, and this is a thin market where the utilities have still yet to really step up to the plate and sign very large contracts with the legacy producers at the prices that they want. That's what we still have ahead of us. So very, very exciting.
Yeah, and I think it's interesting that in the last cycle, the prior early buddings of the nuclear renaissance, we didn't have things like Yellowcake or the Sprott Physical Uranium Trust, and we didn't have producers going into the spot market and buying big chunks of it up like they have over the last few years. So kind of a different market today than we've had in the past with those new elements. And we sure didn't have executive orders from governments talking about building uranium strategic reserves and stockpiles. So just kind of an interesting market to be in. But let's dive down into the supply and the demand side of the uranium companies themselves. On the supply side, obviously the two biggest producers are Kazatomprom out of Kazakhstan and Cameco. There was some news that kind of roiled the market maybe a month back, if I remember correctly, and it was just about they may produce more than people thought, but that was quickly reversed back down to just kidding. Maybe we won't produce as much as we thought. And so give us a lay of the land as far as the supply side. Where's it going to come from, and what's the target versus the demand for the coming year?
Sure. Well, the last that we had heard from Kazatomprom until the recent release was that they intended to operate. They intended to stick with the subsoil use contracts, which is basically kind of the baseline production quotas on a 100% basis for all their projects, both 100% owned and joint venture. And they're allowed to operate within a 20% below or above those subsoil use contract levels. And until this release a few weeks back, what we knew from the company was that they 100% of subsoil use production, which they intended to hit for 2026, was going to be, I think it was 31 and a half to 32 and a half thousand tons off the top of my head, basically 85 million pounds a year. And anybody that's done a meaningful amount of work in the sector knows that there's no chance that they would have been able to hit that. We knew that. We're not modeling for that, but most of the rest of the investing side and some of the analysts that cover the sector were still expecting full production out of Kazatomprom and out of Kazakhstan on a 100% basis for 2026 to be 85 million pounds a year. And that's an enormous amount of uranium. Now, this year we expect them to produce, just under like 72 million pounds for the year on a 100% basis. And what Kazatomprom basically came out in the release is that they are going to adjust down that 100% of subsoil for 2026 by about 8%, if I recall correctly. So adjusting that down. So if they were to operate at 100% subsoil for 2026, that would be 77 million pounds. But what they also included in that release was a couple of very, very important comments. One of them is that they intend to utilize their flexibility option to produce less than 100% subsoil, and that they are not going to update the market on that guidance in the foreseeable future. So we're not expecting guidance for 2026 to happen probably until early 2026. And in the meantime, the market now has to kind of digest that and realize that the biggest producer in the world is telling them that we're not going to hit that mark. We are not going to give guidance yet, and that we are going to be negotiating down the subsoil use contracts on multiple of our joint venture partner projects. So with all of that said, we still expect them to marginally increase production year over year, and that could increase more rapidly in the future when they do finally have this new sulfuric acid plant up and running, which they basically are saying they expect to happen in Q1 or Q2 of 2027. So 2028 and beyond, we could see larger jumps in production. We actually have that modeled out anyways. But for now, it's going to be hard for them to really ramp production in the country until they have much, much more acid. So in the meantime, they're still going to produce probably around where they're producing now, maybe a little bit more for next year is what we're estimating. And the market has to digest that. And you mentioned Cameco as well. If you want, I can get into that, what they mentioned, because I think that's relevant as well.
Yeah, and Cameco is the biggest North American producer, really the only producer in Canada right now, unless you count Orano in there, the French consortium. But Cameco is always a mover and a shaker. What news do they have as far as supply?
So Cameco, they have a decent amount of options, but the really interesting thing about the announcement that they made, which is that they expect for 2025, for this year, McArthur River to come in 3 to 4 million pounds less than the nameplate expected production, which is 18 million pounds a year. McArthur River has been a pretty consistent producer, with the exception of when they voluntarily took it offline. Back in 2018, because of the low pricing, it was Cigar that was offline for COVID for a minute. So in this release, they highlighted they're moving into a new area of the underground mine, and that's creating some challenges. They also mentioned that they're having some challenges with procuring skilled labor. This, in my opinion, was an extremely shocking statement because you have such an established company in northern Saskatchewan with both Cigar Lake and McArthur River and the two mills, in addition to their exploration projects. So they have quite the reach in that province in terms of procuring skilled labor for their mining operations. And if Cameco is having an issue here, and I guess we're not surprised that anyone is having a problem procuring skilled labor because there's a shortage of it to speak generally, kind of globally for anything like this. But if Cameco is having that problem, it poses the concern for other development projects in that area. And there's a few of them. Of course, there's a couple of larger ones near term, which would be Denison's Phoenix. Now, this is a little bit of a smaller operation. It's an ISR mine, so it arguably would require less skilled labor, although still I'm sure they would require skilled labor. And some of that I'm sure they have, but maybe they'd have to procure some. And then the big one, of course, is NexGen's Arrow, which they potentially will have a permit to start development as soon as the middle of next year. How will they be able to source hundreds and hundreds of skilled mine builders for this mine when Cameco, an established company, probably is having a hard time doing the same, and potentially even at very high salaried type of skilled labor jobs? So it's going to be a challenge for the industry to speak generally. So this is not just a Cameco thing. It's not just the NexGen thing. It's the expansion of production has multiple challenges and multiple limitations on what it can do. And one of those is the access to skilled labor. So it's something to definitely watch going forward.
Well, and while we're in Canada, before we shift to the US, let's maybe talk about some of those big development projects you just mentioned. I think a lot of people familiar with the sector will know that Denison has the Phoenix project that's moving towards that ISR production, which has never been tested commercially in the Athabasca Basin, but they've done some pilot testing, some early stage testing. It looks very promising. That would probably be the first one into production. NexGen Zero, as you mentioned, a big project. A lot of people believe it can balance the market. As we've talked about before, maybe, but that's still years away. And then, of course, there's also the Paladin takeover of Fission for their Triple R Patterson Lake project right next door to Arrow. Those are the three probably biggest projects. We could probably just keep it to that. But when do you think it's actually reasonable to see this production actually come online? Because as we know, Justin, everything takes longer and it's always more complicated in mining, especially uranium mining with water issues in the Saskatchewan area. So, what do you think about the reality of when production will actually come out of Canada besides Cameco, and what happens in the years between then and now?
Yeah, that's really the question, Shad. And the reason that is the question is that the supply that this industry is going to be relying on for the 2030s literally is going to have to come out of the ground because we don't have a secondary supply cushion for the industry that has basically been there kind of forever. Overhanging inventories from periods of incredible oversupply. You had the whole, nuclearization decades where Russia and the US were building massive stockpiles of highly enriched uranium. A lot of that came out in megatons to megawatts that ended in 2013, but that was 20 plus million pounds a year for 20 years to the US utilities. Then you had enrichment underfeeding that really went crazy. Then you had Fukushima and the Japanese selling inventory. I mean, the industry has been awash in inventory and secondary supplies for the last 50 years. And that essentially is gone. Now, I don't want to say it's gone. There's always a little bit of flex, a little bit of inventory, but it really happens to come out, let's say, at only price incentive periods. So the Chinese aren't selling their inventory. Do you see inventory start to shake out at higher prices? Yeah, you will a little bit. The hedge funds will have a little bit to sell here and there, but we're talking about an enormous amount of uranium the utilities will have to buy in the years to come. So the industry is going to rely on this supply coming out of the ground from projects that have not even started to be built yet. And that is a situation that is absolutely ripe for disruption. And we're betting on disruption. With all of that said, those three individual projects, PLS, Triple R is the least far along in terms of development. No real timeline for that project at this stage. Phoenix is probably the nearest term because they're also close to a permit. Ideally, we'll see that in the coming months for Denison. And like I said, it's an ISR. It's ISR in the basin, so there's new challenges there. They did have success with their field testing, but who knows how smoothly it's going to go. It's first of a kind. So props to them for going for it. But we'll have to see how that goes. But probably that will be producing sooner than the large Arrow project. Arrow, where can we even start with this? This was the topic of discussion every single conversation in London was when is Arrow going to be producing and who's going to be building that mine? Now, NexGen is telling the market they will be building it, and all signs point to them planning on that. So let's just, for the sake of a thought exercise, assume that NexGen does build the mine, which is to say they don't have a suitor from a large multinational mining company for Cameco, from Orano, whoever it might be, right? They end up building the mine. They get their permit second quarter of next year, and they've got shovels in the ground, let's just say middle of next year. From their own timeline, they're saying that they have a 48-month construction timeline before ramp up production. And so 48 months from mid 26 is mid 2030. So absolutely best case scenario for NexGen to build this mine would be first cake in a can, let's say 2031. And that is if absolutely everything goes perfectly smooth. And this is, again, this is not to say anything whatsoever about the company, because as far as we can tell, they've pretty much done everything right in terms of advancing this asset towards pre-production and pre-development, let's say. This is more along the lines of saying mining is freaking hard, and mining in the Athabasca is very, very hard. So the Southwest Basin, there's been nothing there for many decades. They have to build a mill, and if it's the mill the size that the feasibility study says is 29 million pounds a year, this is the largest uranium mill ever built. And this is a very, very deep mine as well. So all of this is to say that best case scenario, first cake in a can is 2031 from Arrow. That is the best case scenario. And we believe that that timeline is going to be stretched, and there's a multitude of factors that could lead to that. If they do end up having a suitor of some kind, if somebody takes them out or buys the asset, that somebody is going to be doing their own feasibility study and their own mine plan for that asset, which that in and of itself will kick the can down the road 24 months. So if that becomes a takeout, I don't think we're going to see first cake from that project until 2033, 2034, best case scenario. And even if NexGen does build it, the likelihood of it going perfectly smooth is very, very low, just based on the history of mining. Again, not to say anything good or bad about the company. It's just hard. Mining is hard. Nobody really wants to build a mine. And they're going to need hundreds and hundreds of skilled laborers and skilled mine builders. These are not just laborers that can move a shovel around. These are engineers. Yeah, it might be a challenge to find those people if Cameco is having the same challenge right now for an existing mine. So this is the disruptive event, I think, of this cycle. I don't know exactly how it's going to play out, Shad. I don't know exactly when, but we're moving closer to that you know what, or get off the pot moment where they're going to have to build it if nobody takes them out. And if they build it, then they're gonna get into the process and we'll see how it goes. But that's what's coming. So that's why everybody's talking about it. Yeah, we'll see. But supply risk is 100% there because the industry is very, very dependent on projects that haven't been built yet. And that to us is the condition for disruption.
Yeah, I think it's almost like the Guns N' Roses album, Appetite for Destruction, because there's going to be a destruction of source of fuel in the next, let's say, 2 to 5 years that people were kind of lulled into a false sense of complacency would be there. I think a lot of the utility companies figured things would get worked out with Russia, that Kazatomprom would be producing more, that Cameco would be flexing up more, and that some of these larger projects would be further along than they actually are. It sounds like Denison's up first to bat, but even they aren't going to be able to be producing any, as you say, cake in the can, or I guess cake in the ISR wells until, let's just say, 2028, 2029 at the earliest. So it's still a couple year lull here with nothing going on. So that really has us pivoting down to the US, where we've got a handful of small ISR producers and possibly some room for some consolidation, but nowhere near enough production to really make up the demand shortfall with supply. But at least the only area that you see actually mining commencing, production ramping up, a little bit of growth, maybe on a smaller scale than what we'll see from Canada. So when you look to the US, to the producers, and then the near term developers, what's the climate like? Any opportunities there?
I really like the US right now. I think it's a absolutely great market for the US miners. I think that's some of them are overvalued, some of them are undervalued here, but the growth story here is phenomenal. And we obviously have a lot of support from the current administration, a lot of energy, a lot of enthusiasm around building nuclear and shoring up the fuel cycle. So huge opportunities in my estimation for the US miners, 100%.
Now, from a development standpoint and exploration standpoint, and there are projects that some of these producers could combine for future development. We've seen a little bit of M&A in the sector recently, but in general, do you think that some of the US companies need to look to Canada to maybe have cross-border companies? And we've seen a little bit of that with, like, let's say UEC, where they have both assets in the US and in Canada. Do we need to see more of that, or what's your thought on cross-border deals?
You know, I think that there's going to have to be some consolidation, further consolidation in the sector, and that primarily has to do with either legacy producers that need to add to their pipeline, and the big one there would be Orano, but also just consolidation based on, the topic of this conversation, which has been skilled labor shortages. There's only so many people that can actually build projects. And so when you have three different companies with three different small assets, and there's really one or two guys, on all of their teams combined that can actually make things happen, the consolidation makes sense. And I think we're going to see more of that. In my estimation, what we really need to see is the developing companies to stop giving away their uranium. And what I mean by that is there's two or three developing companies that have signed contracts, let's say over the past few months, in the past 6 to 8 months, that have been, in their estimation, for good reason. A lot of times that's to de-risk financing or to de-risk the early stages or in sometimes even late stages of development. But these contracts have been done basically at the current market pricing. So that is to say $80 a pound in the long-term market is kind of that base escalated price floor. And we've seen multiple developers sign contracts at that price or even below that price. There's an African developing company that signed a contract recently, and what we heard was a $60 floors and $90 ceilings. And we think that these contracts are a mistake. We think that these contracts do not actually bring a whole lot of shareholder value, even though they might be de-risking financing for development. There are sunk costs and future costs that need to be considered in contract terms. And I wrote about this in that long form tweet thread that I mentioned, which is this is to say that there's a little bit still of kind of headbutting in the industry right now between the utility fuel buyers and the producers, especially the legacy producers, because you have, these two or three developers that are willing to work with utilities and sign these lower price based escalated contracts or even market reference with significantly lower floors. But the Camecos, the Iranos, the Kazatomproms, they're not signing contracts at that low. Cameco will tell you all day long they want their floors in the 80s. And by the way, this has moved up in the past 3 months. Previously, it was $70 floors, 125 ceilings. Now we're hearing they want mid to high 80s floors and ceilings up to 150. And the utilities are going, well, what the hell? We're here at $76 spot, $80 term. What are you guys thinking? You're really trying to turn the screws to us. And it's like, no, you're Cameco, okay? You shut down MacArthur River for more than 2 years because the price was so low in the market that it was easier and cheaper for you to buy in the spot market. And by the way, those care and maintenance costs were $10 million a month to keep that mine in care and maintenance. These companies went through absolute hell bear market for a decade. They have enormous sunk capital costs for their projects that they built in the past and for the difficult markets that they just endured. And you also have to think about the future. So Cigar Lake is done in the next, 5, 6, 7 years. I'd say by 2035, it's absolutely done and possibly sooner. So that mine cost an enormous amount of money to build. What would another Cigar Lake cost to build right now? 5 billion? So you have to think about your pipeline. You have to think about the uncertainties of the future when at the time you're going to be delivering upon this uranium to your utility, let's say early to mid 2030s. What does that market look like? What is the inflation going to be between now and then? Will those prices still sustain the company, let alone allow the company to add to its production pipeline and continue to service the industry? So these costs, this is not the all-in sustaining cost. This is the fully allocated with the big picture. So the industry is not getting quote unquote ripped off by the producers that are trying to, turn the screws to them and get back at it. This is not a revenge thing. This is not vengeful for Cameco to want these terms. They're trying to operate a profitable company. They have a responsibility to shareholders. They just went through a hellish decade and there's an enormous amount of uncertainty. The future looks bright, but you never know if delivering at $100 uranium in 2033 is even going to keep your company afloat. You don't know that right now. So you have to have this huge cushion in these contracts. And the utilities are slowly coming around to this reality, Shad. And that was another theme from the conference. Still a lot of cognitive dissonance, but there's a few large utilities that get it. And it sounds like that message is kind of getting out there. So that's a really good sign. We know that how much buying they have to do. It's a lot and it's out in front of us. And like I said, in the meantime, there's all these right tail risks that are hanging over the market. We're seeing one of those today.
One last question, and it's on the exploration side of the business. As you know, a lot of investors, especially retail investors that we talk to, are keen to get into new discoveries. Now, while the producers have done well and they react on this kind of news, especially the U.S. producers, when it's something like a uranium strategic reserve in the U.S., makes sense. But even Canada, larger development companies will react to that kind of news because of the friendly partnership with the U.S. and Canada. There are some projects of note in Australia and Africa, and I don't mean to leave them out, but since the propensity of North American investors is to invest in uranium explorers in the Athabasca Basin, in the Thelon Basin, or in the U.S. and a couple key states, what's the environment like there? Because it's been kind of, I don't want to say dead, but it's been a tough slog for the explorers. Do we need that many exploration projects? Is there already enough uranium that's been found? I mean, discoveries usually get rewarded, but will there be a few that emerge as the next developers? What's your take on the uranium explorers?
The explorers are utterly ignored right now. And that is probably an area of strong prospective nature right now. I like the explorers here. I think that some exploration is absolutely still needed. Even though Cameco, for example, has a pretty good pipeline, not only of tier one, but of tier two. They could bring Rabbit Lake back on. They've got some ISR stuff in the US. They've got a couple of other large legacy discoveries that they have in their on their books, but they're also still spending on exploration, right? They're there with Orano drilling out Dawn Lake, which is on the other side of the border from Hurricane. So exploration is absolutely happening in the Athabasca Basin. It's happening in the US. It's happening in Africa. It is happening a little bit in Australia. So it's needed, it's happening. The explorer stocks have been thrown out like the baby with the bathwater. So will we see a moment in time where this sector gets exciting again for investors to speculate on new discoveries? Absolutely. I think that is going to happen. I think that there's some very, very prospective and strong looking hits that have been made with a drill bit in the Athabasca in the last 6 to 12 months. And those companies are still trading, less than 150 million Canadian. So these are very, very small companies with strong looking discoveries. And you also have NexGen exploring at PCE. I mean, this is potentially another arrow that they're onto. So huge upside in explorers, in my estimation. It's been a long time. It's been since 2021, I think, that we've seen a rip-roaring bull market where everything got pulled up, and then you had the small caps really come up at the tail end of that move and blow out in multiples. That could be ahead of us. I don't have a crystal ball, but I do think there's a strong case for owning a basket of explorers for sure.
Well, I think we'll wrap it up there. We kind of covered the whole situation here from the nuclear fuel cycle down into the biggest producers, into some of the near-term producers in Canada, and near-term being years away, and some of the small producers but growing in the US. All the developers and explorers still out there sitting at interesting valuations because the sector isn't red hot, even though there's so many right tail risks and tailwinds for the sector, from big tech to executive orders to commitments from countries for nuclear power to growing global nuclear fleets. There's a lot of positives in the sector and a lot of interesting companies that could re-rate higher over the next few years. For just that reason alone, it's probably worth following Justin Huhn and Uranium Insider, and we will have a link to that down below so you can follow along with the analysis his team puts out. I think it's some of the top-notch analysis in the sector, and some of the only analysis in the sector that you get from a service that you can subscribe to. So, Justin, always appreciate having you on the show to share your insights. Thanks for recapping the recent conference in London, and looking forward to a continued bull market in the nuclear and uranium sector.
It's always a pleasure. Thanks again for having me, Shad. Appreciate it.